Most traders fail at supply and demand because they treat it like a guessing game. They draw a box just like this, pray that price will tap into it, and hope for the best. But real professional traders don't trade like that. They follow hidden rules that are not shared publicly. So in this video, I'm gonna give you 5 advanced supply and demand secrets that help me go from losing money to making 6 figures a month consistently. And this is not some recycled information that you can find on YouTube. This is real high-level insights that actually work for me. So if you've ever wondered why some supply and demand zones work and why some don't, this video is for you. Let's start with the most important rule. Don't trade demand in a bearish market and don't trade supply in a bullish market. This might sound simple and obvious, but most traders get tunnel vision, especially when they are stuck in the lower time frames. They see a clean looking demand zone just like this and they straight away enter for a buy, thinking that price will go up, ignoring the fact that they are fighting against the bearish momentum of the market. You must understand that order flow is basically the direction of institutional intent. So just by trading with the order flow, you are trading with smart money rather than against them. And the truth is, you don't need to guess what the banks are doing. You can see it clearly just by looking at the structure and momentum. So for example, right here, we can see that in the bearish market just like this, price is creating lower highs and lower lows. So we know that supply is in control of price, especially since we are in this bearish order flow. Which means that all these supply zones that we have drawn up right here is most likely going to work. And this also means that these lows right here are most likely going to get broken since we are creating lower highs and lower lows. Which means that all these demand zones at these lows here, they are not going to work whatsoever. So if you try to buy at these demand zones, it's incredibly low probability because you are going against the order flow of the market. And what happened here was that this was that last lower high that led to the break of structure, which means that when price actually take out that last lower high, it told us that the order flow has shifted from bearish to bullish, giving us a market shift. Which means that now demand is in control of price. Demand has overpowered supply, so price is most likely going to create higher highs and higher lows. Which means that all these demand zones that we have right here is going to work right now. And all these supply zones is not going to work whatsoever, and price is most likely going to blast right through them because of the fact that buyers are in control of price and we are creating that bullish higher highs and higher low market structure. Just look at this supply zone right here where price just completely blew right past it. It didn't even cause any sort of reaction whatsoever because demand is in control of price. So the bottom line is this: you always want to trade with the order flow, not against it, because zones that actually align with order flow is much more high probability and has a 5 times more chance of it actually playing out. I started with $20 accounts and now I make over 100k per month from trading, and I've retired my father. If you're stuck in demo hell or blowing live accounts over and over again, you're not the problem. In this upcoming webinar, I'll walk you through the exact process that I used to go from broke, trading tiny deposits, to consistent profits, full-time income, and retiring my father. I will show you the mechanical system that I follow daily, how I manage risk like a professional, and how to build a routine that compounds results without the stress. Save your seat for the May 21st webinar, and I'll show you the exact path that I took to break through, without gambling, guessing, or grinding 12 hours a day. Secret number 2 is higher time frame structure always wins. This is where most good traders actually get wrecked. They neglect what's actually happening on the higher time frame. Here's what I mean. So let's say today I'm looking at price on the 15-minute time frame and I'm trying to trade with the internal order flow. And right now, if I look at this, we saw that price has created a market shift, which signaled to us that price is bullish, right? So we know that we should be buying at all these demand zones right here. So this is the most recent demand zone and I want to enter for a buy right here. So let's look at what's actually gonna happen next. Price just blast right through it and actually stopped us out. And now I sit here crying about the $1,000 that I could have made if I just won this trade. After all, I was right to buy at this demand zone since Brad says that you should be buying at demand when the internal order flow is bullish. So what am I doing wrong here? Well, buddy, the thing that you miss is actually what's going on the higher time frame. So if I go up to the 1 hour time frame, I actually see that price has just mitigated from a 4 hour supply zone. And if you look at the big picture, we are actually in a bearish swing trading range that we have right here. And the reason why price actually shifted bullish is so that it can facilitate that pullback into that extreme supply at this 4-hour swing high to perhaps create a new lower high for price to continue going down. And this is exactly why your 15-minute demand zone got smoked, because the higher time frame supply is just way too strong. This is exactly why it's so important for you to do your top-down analysis. Because if you're just stuck on the lower time frames itself, you're just putting blinders on and you're blind to what's actually going on the higher time frames. So make sure you always ask yourself this question: what's the current objective of price? So if you go back down to the lower time frame, we see a market shift right here. We cannot automatically assume that the entire swing structure on the higher time frame has shifted bullish. That is why it's so important for you to really understand the objective of price. So price has shifted bullish on the lower time frame so that it can actually facilitate that pullback into that higher time frame supply zone. That's what price is doing, which is why instead of entering for a buy at this low probability lower time frame demand zone, you should have entered for a sell at this 4-hour supply zone. That would have been worked out a lot better for you. So my friend, do not confuse a pullback with a reversal. Always make sure you define the higher time frame swing range first before you actually go down to your lower time frame and look for your buyers. And ideally, your lower time frame buyers should be aligned with your higher time frame buyers. So in this case, you have been much better off if you actually entered for a sell at this supply instead of entering for a buy at this lower time frame demand zone. Secret number 3 is not all structural breaks are created equal. Here's what I mean. You can see right here we got a break of structure to the upside, so we can identify our demand zone right here. And later on, let's look at whether this demand zone actually hold or not. Dun, 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 dun. Boom, no, fail, bam. You just lost a trade if you actually entered for a buy right here. Stupid. Oh, what happened, Brad? I got a break of structure right here, so by right, this demand zone should have worked. My friend, breathe, calm down. Let's look at another example here. So this time round, this demand zone led to a bullish break of structure to the upside. But you can see, this time round, the demand zone actually worked. Price actually tapped into it and then pushed to the upside. So what's the difference here? Why did this zone not work and why did this zone actually works, even though both of them led to a break of structure? Because not all structural breaks are created equal. A zone that actually breaks higher time frame structure is much more powerful than a zone that only breaks lower time frame structure. For example, a zone that breaks 5-minute structure is going to be much more powerful than this zone right here, which only broke 1-minute structure. This zone here broke swing structure and this zone here only broke internal structure. And similarly, a zone that actually breaks the higher time frame, the 15-minute, the 1-hour structure is going to be 10 times more stronger than a zone that breaks a 1-minute lower time frame structure. So when it comes to drawing your zones, here's my advice. You always want to draw it on a higher time frame first and map out the zones that actually led to a clear break of structure on the higher time frame or even on the medium time frame, like the 15-minute, the 1-hour and the 4-hour. These are the zones that price is most likely gonna respect compared to your lower time frame zones. Once that is done, then what you can do further is to go down to the lower time frame to actually refine this big zone right here, right? Instead of entering for a sell right here at this supply zone and place a big ass stop loss just like this, you can refine it even further by drawing a 5-minute supply zone right here. And then this way, you might want to enter for a sell at this supply zone instead, and you can see your stop loss just became much more tighter. So my advice is only use lower time frame as a way to refine your zones, not as a way to trade these zones. And when you are identifying supply and demand zones on the charts, you want to ask yourself this one question. Did the zone cause a meaningful shift on the higher time frame? If yes, then it's most likely high probability. If no, then it's most likely a trap for smart money to grab more liquidity before the real move actually happens. The bottom line is this: zones that break higher time frame swing structure are more likely to be respected, while lower time frame internal breaks just like this are just noise unless they align with the bigger picture. Secret number 4 is the compression trap. And this is also one of the biggest reasons most traders get stopped out before the real move. Here's how it works. Look at this supply zone that we have right here. And you can see price is approaching this supply zone, right? So let's zoom in and look at what actually happens next. price started compressing over here, right? It started consolidating, it's grinding slowly at this supply zone. So this is where a lot of retail traders, they will immediately enter for a sell, knowing that price is not going to break past this supply zone since we are having very slow and choppy price action. And they immediately think, okay, price is just creating selling pressure and this supply zone is going to hold. So I'll just enter for a sell right here and place my stop loss above the supply zone. And look at what happens next. Lo and behold, they just got stopped out before price actually moved in their direction. As you can see, later on, price actually went down and actually went in their direction. But guess what? They were stopped out way too early because they thought that this supply was supposed to hold and price was about to go down immediately. But that actually did not happen, right? Price swept more liquidity before the real move actually happens. So here's the catch. The slow grind that we have over here, this compression, is actually a trap. It's basically smart money just building up as much orders as possible here. They are trying to use this consolidation that we have right here to induce you to enter for a sell early. And this also induces the other side of the retail traders who are actually trying to break out. And when price actually breaks out of this consolidation, breaks out of this supply zone, this also induces the retail traders who are entering for a buy, trying to trade this breakout right here. That is where they will actually enter for a buy right here, place their stop loss below these lows here as well. And then that is where you will see both the sellers and buyers get stopped out before the real move actually happens. And by the time that actually happens, guess what? You are way too late. You already lost your life savings or something. Which is why if price approaches your zone with this corrective price action and it seems like it's just compressing and just going sideways just like this, you want to be careful. You want to be cautious. You don't want to enter for a sell or buy way too early. Because you must understand that the best reactions always come from impulsive entries from zones, right? Just like this supply zone that we have right here. Price reacted to this supply zone and it straight away pushed to the downside. Compared to, you know, just having like choppy price action right here. Secret number 5 is how to trade consolidation like smart money. You probably heard me saying this 1,000 times by now. Do not trade consolidation. The reason why I say this is because I love you. I don't want you to lose money. Because I've seen consolidation kill more traders than bad signals. Because it looks like an opportunity, but in reality, it's just smart money accumulating or distributing. And here's the thing, most retail traders get chopped up trying to trade the breakout. They will start to enter for a sell right here, just for price to blast right through it, and then they will enter for a buy right here, and then just for price to just blast right through it before going in that direction. And the thing you must understand about smart money is that they are not trading when price is in the middle of the consolidation. They are stacking up orders at the high probability zones within this consolidation itself. And the only zones that actually matter in this sideways market is the extreme zones. So if you're facing a consolidation just like this and you want to trade it, here's how to do it properly. You want to first identify the swing high and the swing low so that we can really narrow our attention and our focus to this tight swing range that we have over here. The next thing you want to do is to identify the extreme supply zone and the extreme demand zone. It's not the demand zones or supply zones that is in the middle, it's the ones that are at the extreme. And how you want to do that is by taking out your Fibonacci tool and find out what's the bottom and top 30% of this range. I'll put the settings for this Fibonacci tool on the screen right now for you to copy, so you can just pause this video and just copy this to your Fibonacci settings. Once that's done, you can clearly see that this is the top 30% and this is the bottom 30% of the range. So that is where you want to identify a supply zone that is in the top 30% and a demand zone that is in the bottom 30%. And these are the zones that you can trade from. So ideally, you want to buy from this bottom 30% of the range. You can see it reacted really, really well. And you want to sell from this top 30% of the range. And once again, you can see it reacted really, really well right here. Right, so you could potentially catch some nice scalping opportunities from this area right here and try to trade it down to this area and vice versa. And you want to completely avoid trading the zones that is in the middle 40%, right? Because these are the zones that usually fail. Don't take it from me, just look at the supply and demand zones that we have inside this middle area. You can see over here, price did not even tap into this supply zone, and over here, this demand zone just failed completely, and you can see this demand zones just failed once again. And you can pretty much see all the instances where the supply and demand zones within this 40% range just fails completely, just not working well, right? So you're just wasting your time and your money if you're trying to trade this middle 40%. And And the reason why the middle zones fail here is because there is no edge here. There is no liquidity, there is no displacement, there is no manipulation. It's just indecision. We can't clearly tell who's actually in control of the market right now, whether that's the buyers or the sellers. And here's another trap. You don't want to be trading the consolidation when it's about to end. When price compresses at the top or bottom just like this, volatility dies down and volume dries up, and it usually means that a breakout is about to happen anytime soon. At that point, you are much better off just waiting for price to actually break out of the consolidation, and then you try to trade the retest of the breakout itself. So when the market is ranging just like this, you don't want to trade emotionally. You want to trade like institutions. You want to build positions in a very smart manner at the bottom or top 30% of the zones. And you don't want to be that guy who's late to the party. So avoid trading the consolidation when price is compressing at the top or bottom 30%, because we know that a breakout is about to happen very soon, and it's much better for you to just trade the retest of the breakout itself. So the bottom line is this: don't trade consolidation. But if you do want to trade consolidation, you should only trade it if you're entering from the edges, the top and bottom 30%. If you are in the early or the mid phase of the range itself. You don't want to be trading from the middle. You don't want to be trading when it's compressing and it's about to break out. So these are the 5 supply and demand secrets that they don't teach you in free content. If you're still struggling with over trading, hesitation, or second guessing setups, this is your roadmap out. Because these secrets don't just improve your entries, they change the way that you think. They change the way you see the market. But if you want to go deeper, I've recorded a free training that breaks down how to master trading in 2025. In this video, I'll show you the exact system that I personally use, how I find sniper entries, how I manage risk, how I scale my account to 6 figures, even in volatile conditions. So just go on, click on the video right now and watch it till the end, and I promise you it will shift the way that you trade forever. And as always, remember, you're just one trade away.